So we came in today following this huge sell-off caused by the FOMC statement and what Jerome Powell had to say. There will be fewer interest rate cuts next year than was previously planned. So yesterday really had lots of big selling, more than 200 points down. And coming into today, we can see that these bars are about 3 times the size of what the average bar over the last couple of weeks has been. So looking at this bar 1, it is about 23 points. So the bars are much larger than what they have been. And when that's happening, you need to make sure you're trading smaller. Like your position size is smaller, so your total risk is no larger than any other trade. So what I would recommend when the market has these big bars like this is to basically trade a third of your normal size or a fourth or a fifth of your normal size. And then you can still take the same trades. The entries should be, you can still apply your same strategies, but your position size needs to be smaller. Also, because your risk is also going to be larger, you should also be going for a larger profit target. So, for example, normally a scalp is 5 points, but when the bars are 3 to 4 times larger than normal, I would say a scalp would be instead 15 points. So that coming from someone that used to scalp for 1 point, considering a scalp 15 points is that's different. It sounds kind of crazy to say a scalp should be 15 points, but at least for today, at least for the first half of today, and it could continue tomorrow, maybe into next week, we will have larger bars, more volatility. So should be trading smaller when you're seeing these larger moves. First trade, I want to mark this trade as well. So after yesterday's big sell-off, I would expect there to be some sort of follow-through selling either today or tomorrow or next week. Today did not have much follow-through selling, although it did close lower than where it opened. Since we're expecting follow-through selling, where might be some of the targets? Well, close of yesterday is always going to be a target. And where did today work its way down to? Right at the end of the day, it almost got down to the close of yesterday. It got two points away. And I see my head's in the way. So the close of today was 2 points away from getting to the close of yesterday. And so that's no coincidence. The market basically worked the whole day down to try to get to that level. Another target would have been the low of the day. So why is the close of the day important? Oh, let's look at the daily chart. Big bear bar, big sell-off. When the bears see that, when they see a big bear bar, many will sell the close of that bar, betting that either the market will go lower and they can make money, or they'll be able to sell more higher and then get out at their first entry here. So let's say they sold this close yesterday. For someone trading the daily chart, if they sold the close, they're probably going to sell more higher and be selling into this overnight gap up. And then that's why yesterday's close is a target, because once it gets back there, some of those bears that shorted higher will be getting out at that level. And you can see we almost got there today. So with that in mind, we're looking for follow-through selling today with targets below. We'd like to be selling below bear bars around the moving average. And this third bar here and this fourth bar, what do we have? We have the bulls trying to go above the moving average, then pulling back below it. Then we're getting a good signal bar below the moving average. And like I was saying in the review from yesterday, when you have a bar closing near its high or low, So a bear bar closing near its low, that's a reversal bar. That's usually good for a scalp. Like I was saying, scalp today would be 15 points. So 15 points would be right here. Maybe some would get out above this bull bar. Others would be getting out here. So 15 point scalp right there on the open. Coming down lower, really any of these bear bars, any of them could be marked. Maybe some are better than others. But the idea is you want to be looking for bear bars below the moving average and trying to sell below those. So if you're taking that idea, one way you could do it, if you think the market's going down, look for a bear bar, sell below it, and then just put your stop at the top of the most recent high. So that'd be up here. So people will sell here, they stay in through this. And then, so really they'd stay in the whole day, in theory, with their stop up here. They'd sell below basically any of these bars below the moving average. And then they get out at the end of the day here. So that's one way you can look at a day like today. But looking specifically at what I have marked, I like this bear bar here. We can see the tail on top. The bulls had tried to go higher during that bar and then failed. And then this bar even closed below this tail here. So that means that the bears were strong enough to be able to close the bar below the prior low. That's usually a sign the market's going to go lower. If someone was scalping there and put their stop above, then they would have been stopped out. They would not have gotten their 15 points by selling below that. Although I think that is long term, I think that's going to be a good trade to be taking. The next trade is once again below the moving average right here. We can see, look at first bar closed above the moving average and was sold off. This fairly strong move up, 3 bars up, ultimately got sold off. And then once we get back below the moving average, I like to look for those shorts below the moving average. And then you can get your 15 points there. Market went down 15 points pretty quickly there. Notice these lows that were starting to form here. It's starting to form a support level through here. I can draw that in. So 5 tests of this level. At some point, the bears give up. Any of the bears that have been shorting through here, they have their short positions. And at some point, they say, we've been trying to get through this so many times, and they start giving up. And when they're giving up, they're getting out above bull bars. So I like how this bar came back above the moving average. So a good chance that you'll be able to get a scalp there. So I like buying there. Kind of same story as the market is moving up here. We have this previous high. And look at this bull bar. This is a great looking bull bar, right? Minimal tail on bottom, almost no tail on top. It was 14 points tall, almost entirely body. Great looking bull bar, but it got sold. Immediately it was sold. And as you look at all the bull bars on this chart, all the bull bars closing above the moving average, they got sold. The market had such a strong sell-off yesterday, and we're expecting more selling to happen. And what some people will do when the market is on the larger time frames going down, they'll look for these bull bars like this, and they'll actually sell the close. So I could imagine beginners getting excited and seeing this strong bull bar like this, and they're saying, "Oh, the bears are trapped, and the bulls are winning, and they're gonna trap out the bears, and bulls are gonna go up." When in fact the opposite is happening. It's now near the top of this trading range, and bigger context is that the market is in a bear trend. And so these bull bars are actually being sold instead of being bought. With that in mind, as people had bought this close, they are disappointed by these 3 bars. They're, imagine if you had bought this and then you saw these 3 bars and now the market is against you 20 points. You get a little bit of hope here with these 2 bull bars. But then once the market starts to turn back down below the moving average and you get these bear bars below the moving average, at some point you have to say, I'm just giving up. I'm just getting out. And that's what happens. The bulls get out of their long positions below these bear bars here. So I like to be scalping in that area. That's all the trades I had marked. Normally don't trade too much after 3 o'clock. I made sure I wanted to point out that the low of today nearly got to the close of yesterday. And I'm sure that'll be an important point to be tested tomorrow. We got pretty close. I mean, I would basically consider this a test, but I think the market still wants to get exactly to that close. I think there's going to be lots of orders right at that price, and the market will want to get there. So big takeaways: when the market has large bars like this, make sure you're trading smaller. So maybe 1/3 your size, or a quarter, or a fifth of your normal size. And then you can also expand your risk and your profit targets to accommodate the larger moves. Also, I wanted to talk more about yesterday's sell-off. So the Federal Reserve lowering the rates by 25 basis points, that was expected. What was not expected was them lowering rates in the future slower. They're going to have fewer rate drops in the future. Anytime you have something like that, when they come out and say we're going to raise rates at a faster rate than we were planned, or we're going to lower rates at a slower rate or faster rate, the market is going to react to that, and it's going to react to it not just immediately, but over the course of several days. I would expect that we will have more selling off of this. Maybe we'll have a rally for a few days or even a couple weeks, but I would expect that at least we'll be in a trading range. I could see us going sideways from here. Let me see. Got to find my tool here. I could see us going sideways through here, being in some sort of trading range like this. And I think that'd be the minimum. I think we're either going to be in a trading range or we're going to have more selling, and selling down to this measured move target and this the 200 moving average around here. So I think we're probably in the middle of a larger trading range right now. So we could have rallies, but those rallies probably wouldn't have much follow through. So looking back at the sell-off that happened yesterday, when the sell-off is happening, these bars are very large. Like I'll just pick, one of these average bars here. That's a 17-point bar, and we had many of those bars, and many of them were much larger than 17 points. When you're having this sell-off, either you continue to trade the same way, but you reduce your position size. So maybe instead of trading 5 points, you would go down to 1 point. And then what you're doing is you're selling below these bear bars like this. So you put your stop above, and if your strategy is to sell below bear bars like that, then you follow that, and you follow your same rules. You just trade a smaller position size. Along with that, another way to do it is to look at the 2000 tick chart. And on the 2000 tick chart or any lower time frame chart, you're going to get entries on it. So let me go back to. So this is that sell-off that we had yesterday. Now, that moving average magic video I had, that goes over a lot of different trades and trade ideas that you can be taking in a downtrend like this. Just looking at the chart, I mean, what works? Basically, pullbacks to the moving average and selling below bear bars. So, say we sell here and we try to go for 2 times our risk. put your stop above. So you would have been stopped out here, but then you enter this bar and you would have made your loss back there plus some profit. And if the market is really showing signs of strength, maybe instead of going for 2 times, you go for 5 times your risk. And then that would put your profit, somewhere down here. And you could have continued to do that the whole way down. You're going to lose some, but then when you win, those are going to well offset your losses. So in a strong trend, that's one way to do it, is to drop to a lower time frame and look for these pullbacks to the moving average. All right, guys, thanks for watching. If you have any questions, just go ahead and put in the comments. I'll be happy to answer. And have a good night.